The deeper signal in today's gold and silver market has nothing to do with hype or retail excitement. According to Matthew Piepenburg, what we are witnessing is the slow failure of a system that relied on complexity, leverage, and public disinterest to function. For decades, paper markets were used to manage perception, keeping precious metals contained through derivatives and rolling contracts that rarely demanded real delivery. That structure only works as long as physical supply is assumed, not required. Once that assumption breaks, price control breaks with it. And that is exactly what is starting to happen. When gold and silver began moving higher alongside rising debt stress and currency decay, the usual suppression mechanisms were no longer there to force prices back down. Not because of enthusiasm, but because the metal simply wasn't available. This is why the recent move matters so much more than past rallies. Gold is no longer just reacting to inflation headlines or rate speculation. It is responding to distrust in currencies, in settlement systems, and in the promise that paper claims will always be honored. Silver, historically quieter early in cycles, is now behaving as it always does when confidence fractures, tightening violently. Physical demand is rising at the same time paper leverage is losing credibility. When contracts are called instead of rolled, the illusion ends. What emerges is real price discovery, and that process is never gradual. It happens when markets realize there is no longer enough metal to satisfy the structure built on top of it. From here, the path forward is not defined by optimism, but by constraint. Central banks are not speculating. They are repositioning. They are preparing for a system where gold functions as collateral, settlement, and insurance beneath weakened currencies. Silver follows that shift with far less depth and far more volatility. If trust continues to erode and physical demand keeps draining available supply, the repricing of both metals will not be a choice. It will be a necessity. In this video, we'll break down the forces reshaping the gold and silver markets, from supply chain pressure to institutional behavior. If you value analysis that looks beyond price and into structure, be sure to like the video, subscribe to the channel, and stay with us for the full discussion.
We're shocked but not surprised. I mean, we've been talking about this for years. Yeah. And by the way, for those many years, gold was being mocked by the street as a pawn shop asset or too volatile. Looking back over the last quarter of a century, it's outperformed even this S&P in total return. So there was a deliberate attempt to misunderstand precious metals. We've been talking about precious metals as being a far better store of value, not in appreciation versus the S&P, but in holding its purchasing better than a fiat currency. So what does this mean when we look at $5,000 gold? If I had talked even a year ago here about $100 silver, I'll be selling his book. I get it. Yeah. And my BS detector, when I was allocating money to others, I was always, where is this becoming extreme? Sure. And I am very cynical and skeptical, as anyone should be listening to me or anyone else. But do your own homework and think about this and come with your own conclusions. But what we're seeing really in this, what John Rubino rightly called just a horizon of distrust across everything, whether it's left or right politics, whether it's globalism, whether it's immigration, whether it's social unrest. We all have a different opinion. We just don't trust the decisions, and we argue about that. But I think when you look at $5,000 gold, you say, this is a bubble. This looks like NVIDIA, or this looks like Lucent or Qualcomm or Amazon circa 1998. I get it, but it's actually much more disturbing than that. Again, take out my bias if you can. Yeah. It's what we're seeing with $5,000 gold isn't a sign of how bubbly gold is. It's in a bull market. It's a difference. The reason it's in a bull market is not that $5,000 gold should shock you. What should shock you is how bad fiat money has got, that gold has to be $5,000. It's not just a bunch of retailers going crazy to follow the trend. The bulk of this demand is coming from central banks. Yeah. Retail sector is hardly allocated at all. You see it on news. It's nothing compared to what central banks are buying. And again, when did Noah build his ark? Before the rain. When do you load your gun? Before combat. When do you stock up on food? Before the snow. What we've just been seeing since we weaponized the U.S. Treasury and the world reserve currency in 2022 is a tripling of central bank gold buying. It should be a massive headline. Why are they doing that? They're building the ark before the rain. They see the rain coming. What are they building that ark with? Gold. I'm sorry, I may be a gold guy, but that's not a bias. The world sees this. The BIS sees this. Ray Dalio sees this. Druckenmiller, Paul, it's not just the gold camp. Even Morgan Stanley sees this. So again, get past, he's selling me something, do your own homework. $5,000 gold, of course it's disturbing, but as many of us and we meant this, I'm not hoping gold gets to 10,000. I'm afraid it is, because if gold gets to 10,000, what that symptomizes, what the symptom of that is a credit system literally burning right in front of our eyes, and a currency system melting in front. And it has been slowly since 1971. Now it's happening exponentially, and that's the real issue. It's the currency. It's the currency derivative of the debt market. It's the explanation of this gold market, and of course the COMEX can't keep up. In a way, we're getting our signals from the East, not the West. And whether you like them or not, I have no desire, as I said many times, live in St. Petersburg. I'm not a shill for Shanghai. I'm a capitalist. I'm an American. I live in Europe. I'm binational. I love the West and I love capitalism. But look, you look at the BRICS, Enbridge, all these discussions, de-dollarization that's been here since 2022. We all get it. It was never going to be a BRICS-backed currency, a gold-backed BRICS currency that all the BRICS nations and what they did, because the BRICS countries don't necessarily trust each other, but they do trust gold. And what they're coming up with, slowly but surely in the laboratories of their long-term thinking, is making gold 40% of any net trade settlement in the BRICS world. So they'll do regional currencies and regional trades on anything from energy to widgets, and then they'll net settle that in gold, which is a brilliant idea. Yeah. That way, each nation has the right to still debase its own currency, because every debt-strapped nation eventually wants the freedom to debase its currency in an emergency. If you have a gold-backed currency in those nations, you can't do it. So that's being realistic. But if you're going to trade, you've got to have a real asset, a coverage, and that's gold. Even the IMF during the COVID hysteria, when they were talking about the new Bretton Woods 2.0, they said in their little chart, if you watch their video, at the bottom of that chart is gold in the new central bank digital currency dystopia. The only good part of that, for it to have any credibility, it has to have some gold coverage. So gold doesn't become a new currency, but it becomes part of the ratio. And it's emerging everywhere. And again, that explains why the bad guys are stacking up. 100%. Watch what they do, not what they say. Yeah. I'm not a fan of any of these parties. Yeah. But you can't deny, don't fight the Feds, don't fight the central banks. They're stacking for a reason. It's not just because it's a trend.
And I mean, distinguish between, I guess we'd call it transferring debt, which is fiat, versus paying it off, which is gold.
Well, you could reprice gold. You could take the 260 million ounces in the U.S., reprice from $42 to whatever price at spot, or maybe higher. And that's a little QE with gold. That takes some of your debt level dents down. That's a whole other conversation. Yeah. But in the meantime, gold will give them some liquidity. But what they'll probably do is they'll just inflate away their debt by debasing the currency and lying about inflation. That's the current mode. And then eventually we'll make it more digital.
Yeah, CBDC, that type of...
Some type of dysfunctional reset where Bretton Woods comes in and we say they'll blame it on anything but themselves. Before it was COVID, then it was Putin, and next it'll be Venezuela. Who knows? They'll be a bad guy. It will never be the bathroom mirror of the very policymakers who for decades have driven us into this wall, in particular the U.S. and the Fed. Who's going to replace the dollar for the world reserve currency? Who has a better bond market than even our bond market? China doesn't. Yeah. Who has more? Even with us, even with Trump and all the distrust, the U.S. has some more credibility than any other nation. It also has the cognitive, the memory of it, the muscle memory of it. But its share of FX reserves is getting lower and lower. But it's still a major part of FX swaps. It's still critical to the U.S. Treasury is critical to derivatives trade, which is another topic of risk. But no, the dollar's not going to be replaced. The Chinese and Russians aren't stupid. They're not going to try and beat the dollar. They're going to go around the dollar, just like a good army would do if they hit a wall like the Maginot Line. They just go around it. They flank it.
So we'll use dollar for commerce, but central banks will use gold for collateral.
So what I do, I save it gold and I spend in fiat when I need to buy something. If I have a big purchase, I'll take some of that gold and I'll liquidate it into fiat, which is functional. I can't go into a Costco with a 100-gram bar or a 100-ounce bar. Exactly. But I understand, I respect it. I don't see it being money, but I see it as being a better store of value, just like the banks and the BIS say it is, just like the evidence shows. Again, why central banks have more of it than treasuries. And they've been building that for years. They're saving in it. Because saving in U.S. treasuries and U.S. dollars is saving in an ice cube that's melting. And even the petro trade, the volatility with that petrodollar, it was so much less when they had a gold backing. So even that's getting a little weaker. There's cracks in the oil trade. That's another hour, but it's fascinating too.
As you heard, another renowned analyst, Rick Rule, highlights the same pressures Matthew Piepenburg has already warned about. With gold at $5,000, Rule explains this isn't about hype or retail frenzy. It's about a structural shift in the system. Central banks are quietly stacking, physical supply is constrained, and the old mechanisms that held prices in check, leverage, derivatives, and paper contracts, are starting to fail. This is exactly the environment where owning physical gold and silver moves from optional to essential, not as a speculative bet, but as insurance against the unraveling of fiat currencies. Rule emphasizes that the surge in demand is not coming from casual investors. The bulk is coming from major players who understand the fragility of the global financial system. Silver, though smaller in market size, is facing the same structural squeeze, making it highly sensitive to shifts in supply and demand. Mining production, which often relies on byproducts and lower margins, suddenly gains leverage at these price levels. Physical metals are being hoarded, not rolled, and this scarcity is creating a setup where prices can spike suddenly, without warning, once the market fully recognizes the constraints.
Don't get me wrong, we're going to get through this. But the next 10 years are going to be a lot more challenging than the last 40 were. What the $5,000 gold price is telling you is what I've been saying on your show for 4 or 5 years, which is to suggest that fiat currencies, almost all of them, will lose a substantial amount of their purchasing power over the next 10 years. And that real interest rates are negative. That the money that you make on a euro-denominated bond or a dollar-denominated bond is less than the rate of inflation. That's a lousy outcome. The period 1982 to 2022 was probably the most benign financial climate in human history. And people are still trained to expect benign climate. And the next 10 years, if I'm right about the decline in purchasing power of fiat currencies, will be much less benign. If you think about, you live in Germany, so a Eurozone denominated retiree, he or she is getting paid 2,000 euros a month on their pension. If I'm right, and the purchasing power of the euro declines by 75%, that person will need to 8,000 euros in 10 years to buy what 2,000 euros buys today.
No.
And that won't happen. And it's going to impose a real hardship on people who haven't adequately provisioned for their retirement and people on a fixed income. I sold 80% of my physical silver. I kept 20%. And I sold it because silver occupies the speculative part of my portfolio. I said in your conference, I save in gold. I maintain liquidity in US dollars, and I speculated in physical silver. I bought my physical silver 4 or 5 years ago when it was hated, and I bought it specifically because it was hated. My belief was that when the hate wore off, that silver would clear up to $50. I was wrong. It cleared to 75, and beyond that today. In my portfolio, when an asset class performs to expectation, I sell it. I reallocated the money speculatively too. I reallocated it 50% as to silver stocks, high quality silver stocks. My rationale was if silver stayed within spitting distance of today's price, if it didn't go up for a year, the high quality silver stocks would go up by 50 or 60%. So I felt that there was more speculative leverage in the high quality silver stocks than there was in physical silver.
Absolutely. No.
I also had a 7-figure gain. And you haven't made the money, Kai, unless you've taken it.
Yeah. Paper gains are worthless.
Correct. Might be described as silver companies in drag. I consider Wheaton Precious to be a silver company. I consider Pan American to be a silver company. I consider, perhaps erroneously, Peñoles and Buenaventura to be silver companies. But for the amount of money I had to allocate, it was fine. I didn't come very far down the quality trail. On the speculative side, I allocated some more to both Abra and Wisla silver, but that's as far down the quality trail I went, which is pretty high.
Well, they're excellent world-class developers, right? Absolutely. Like Wisla Silver is supposed to be one of the largest silver producers, single asset silver producers if they go into production. Right. So, no, fantastic. You mentioned it earlier before we hit the record button that not all trees don't grow into the sky. There's usually a limit to it at some point. Right. Like, what's your assessment of the market right now? Like, where are we at? You said overvalued already, but
it's ahead of itself.
What could upset the train, though?
This is I don't know. I mean, one thing that can upset the train is it simply gets overbought. If you see these parabolic charts. The Canadians call them hockey stick charts. Around silver is an example. I've learned in 50 years in the market that the backside of a hockey stick is just as steep as the front side and much less fun if you're long. So a lot of people get excited by hockey stick graphs, and I get terrified. I'll just say that. I'm an old man. I've been through a lot of markets. I like to take my money. I'm of two positions. I think, and I've said this at your conference, I think over the next 10 years, the real purchasing power of the US dollar declines by 75%, which suggests that the gold price in nominal terms should do well. I also believe separately that our society has underinvested in productive capacity around industrial materials, copper, oil, things like that, for 30 years. There'll be supply shortages. So the long-term macro is spectacular. I had an expectation that 2025 would be a good year, which I interpret as a 25 to 30% portfolio gain. I got 150 to 175. That suggests to me that I've used up 3 years of gains in 1 year. And that tells me that I needed to take some money off the table. If you buy a deposit that isn't economic at current prices, but is economic at a price that the commodity would have to go to for the industry not to be in liquidation. Optionality made me, by my standards, a boatload of money in the early 90s, because after the decade of the 1980s, nobody thought resource stocks were going anywhere. So as an example, forming Silver Standard and Pan American Silver, we were able to buy deposits that they'd cost $70 or $80 million to drill off. They made no money at $5 silver. Probably wouldn't make any money till $15 silver. We were able to buy those deposits for 10 cents an ounce. We were able to buy deposits that had cost people $75 million, $80 million to discover. We were able to buy them for $2 million, $3 million. We made so much money in those days that we popularized the whole sector. The difficulty today with optionality is the cover charge. The market capitalization that you have to pay to participate is way, way, way too high. For a trader, it still works. For an investor, the juice isn't worth the squeeze.
As you watch gold and silver quietly move through the cracks of the system, you have to ask yourself, how much longer can this hold? Paper contracts, exchanges, and derivatives have controlled the narrative for decades, keeping prices contained, giving the illusion of stability. But that control is failing. Slowly, almost imperceptibly, the real metal is being called for, settlement by settlement, delivery by delivery, and the machinery that once suppressed price discovery can't keep up. What happens when the system designed to hold gold and silver down simply runs out of tools? The risk isn't gradual. It isn't slow or measured. It's explosive. Silver, in particular, is sitting in the crosshairs. Small in size, high in sensitivity, it could be the spark that ignites a chain reaction, forcing the market to recognize the scarcity that has been ignored for too long. One delivery fails, one short gets called, and suddenly, prices are not moving. They are leaping. And when that happens, the ripple effect doesn't stay in metals. It questions fiat itself. It forces every investor, bank, and government to confront the reality that money they trusted may be far weaker than they ever admitted. So where does that leave us? Will the metals finally reclaim their role as a cornerstone of value? Or will the disruption reveal cracks in the financial system we didn't even know were there? The tension is building quietly, relentlessly, and one can't help but wonder, when the first real shock hits, who will be ready to survive it? And who will be left chasing a price that suddenly makes no sense at all? Share your thoughts in the comments. Your perspective might help someone else see the bigger picture.